All right, this is a lecture on earnings per share. We're going to learn about creating basic earnings per share and diluted earnings per share. This is a GAAP number. So this isn't some kind of number that we just come up for the sake of financial analysis. This number is reported on the financial statements, and if there is one number that's the superstar of financial accounting, it is earnings per share. Now, every company will have basic earnings per share, and any publicly traded company is going to also have diluted, most every. Um, so, diluted EPS, it says on your slide here, if you're reading it, required for complex capital structure. That means if there are any potentially dilutive securities, so those are securities that are the dilutive securities you learned about in the previous lecture, then you're going to have to report diluted EPS. In some cases, it may still exactly equal basic, but you will report both numbers because it's informative to the users of the financial statement. So, if there are any convertible bonds, convertible preferred stock, options, or warrants, then you're going to have to create diluted EPS. The final thing we're going to do is take a in-depth look at diluted EPS in our anti-dilution revisited case, which is from your textbook. Okay, to emphasize how diluted EPS is a worst case scenario. So the idea is basic EPS is what really happened. Diluted EPS is what could have happened if everything absolutely went wrong with conversions or exercises. And by wrong, I mean against the interest of the existing shareholders. Um, so between basic and diluted EPS, within that range, you have the probably what's the most likely scenario. Um, so diluted EPS and basic give you a range as an investor, as an analyst. Okay, so there's some logic to what the FASB did in making diluted EPS be a worst case scenario. Okay, so let's look at the basic earnings per share calculation. You're going to have adjusted, and I'm looking for a formula here. Okay, I didn't put some just visual formula up here. So let me just write it out in a little space. So you have an income measure over a share measure. So, if you're an investor, you're not going to buy all the equity in the company. So you're going to buy some number of shares. It's useful to measure the income generated on a per share basis, right? So what we're going to end up doing is you're going to take net income and subtract out I'm going to call it a preferred dividend adjustment. Your book just calls it preferred dividend, but you're going to see it preferred dividend. The actual preferred dividend isn't always the same as the adjustment number for earnings per share. And then in the denominator, there's this thing called weighted average common, wait for it, still coming, common shares. Here we go, almost there. Common shares outstanding. Okay, whoops. That crazy little button on this pen. So net income minus the preferred dividend adjustment divided by weighted average common shares outstanding. That gives you earnings per share, and we measure it to the penny. Okay? And, I describe it in words here in the lecture note. Okay, here's the dividend adjustment. So, and I call it here an EPS specific preferred dividend. First of all, if it's non-cumulative, you're really having two cases. If the preferred is non-cumulative, you're going to reduce net income by the actual preferred dividend declared and due to preferred stockholders. So if it's non-cumulative, then do your normal preferred dividend calculation. that you would do if you were calculating what preferred dividend is the stockholder getting. What's a little more confusing, but it's really simpler if you adhere to it. So hear me now, believe me later. If it's cumulative preferred, ignore any dividend declaration information and always subtract out only the current year's accumulation. Okay? The idea with cumulative preferred is if they didn't pay the last 10 years, well, they still have to pay it before they pay a dividend. But those last 10 years accumulations, we subtracted from net income in those years. So it's like what it's saying is if you have cumulative preferred, we're essentially going to accrue the cumulative preferred dividend whether or not declared. Okay? Alrighty, so let's see. That is the numerator. In the denominator, you have shares weighted by the fraction of the months they are outstanding. So we have weighted shares. Let me show you the easiest scenario. Well, let me show you first example. 500,000 shares all year long. Then 12 out of 12 months times 500,000. Weighted average shares equals 500,000. Okay? That's a snoozer. Alright, now let's say on 1/1 of FYX1, you have 500,000 shares. On 7/1 FYX1, you issue 200,000 shares. Then, for 6 out of 12 months, you had 500,000 outstanding. And for another 6 out of 12 months, you had 700,000 shares outstanding. That means your weighted average shares were 600,000. Okay? So the month comes into play right there in the numerator. How many months did you have that number of shares outstanding? Okay. The final thing to recognize with weighted average shares is we're going to treat stock splits and stock dividends as if they occurred at the beginning of the year. All right? What the impact of that might be isn't perhaps clear now, but when we work with some numbers, it'll be more clear. All right? Diluted EPS. Well, let's come back to it. Let's get some basic EPS stuff out of the way here. Alright, in this example one I have an ABC, and the reason I did this is this preferred dividend adjustment. It really isn't that complicated, but I think many students overlook it, and this simple issue of cumulative versus non-cumulative in EPS can result in a lot of wrong answers. So let's do these. Weighted average shares are 637,500. So we're not really worried about that calculation here. They have 1,200 in net income. So in all cases, it'll be 1,200 net income. The cumulative preferred stock accumulates 300,000 in dividend per year. Calculate basic EPS for each scenario. Okay, so in this case, we're going to have cumulative preferred. And that cumulative preferred accumulates 300,000 per year. And what I have told you is when you have cumulative, just subtract out the amount accumulated per year and ignore the dividend declaration. So in this case, when you have cumulative preferred, it doesn't matter what the dividend declaration is. the basic EPS is going to be the same. So case one, I try to bait you by saying Davis has 800,000 dividends in arrears, and then they declare 1.3. So how much are they actually going to get? Is the cumulative preferred stockholder going to get 800,000 plus 3? They're going to get 1.1 million. But for EPS, all we're going to do is subtract out current year's accumulation, and basic EPS is $1.41. Second case, no dividends in arrears, but they declare 400,000. Okay, so they're going to get 300,000, and that's what we subtract out. So in this case, the payment of dividends and the preferred dividend adjustment are the same. Now, in the last case, there's no dividends in arrears, but they don't declare any this year either. We still subtract out the 300,000. For cumulative preferred stock, ignore the declaration. Subtract out the current year's accumulation. Now, for non-cumulative, you better believe it matters, because we want to know exactly what the non-cumulative preferred stockholders got. So we'll have this problem in example 2, still 637,500 basic weighted average shares and 1.2 million net income. Company has non-cumulative preferred stock, and it accumulates 300,000 in a year. The current year's dividend is always 300,000. They have passed a total of 800,000 preferred dividends. We don't care because it's non-cumulative. Calculate basic EPS. The company declares 300,000. Well, I can tell you right now, if it's non-cumulative, anything over 300,000, you're going to subtract 300,000. Anything greater than or equal to. They declare exactly 300, we subtract 300,000. The company declares no dividends, you don't subtract any. Anything from 0 to 300,000, you would subtract out exactly the declaration. Okay? So that's the non-cumulative versus cumulative preferred stock dividend adjustment. I think that's probably a good place to break the video lecture, and so it doesn't get too long. And we'll pick up on the next